Today's session is going to be supply and demand, and it's going to be also on top-down analysis. To be transparent with you, I'm not going to cater this towards new traders. I'm sorry. I'm just going to teach it the way that I would want you to know it. And if there are things that I'm saying that you don't fully understand, that's fine. You just go back and watch the recording, and you'll understand it, right? I think it would be a disservice to kind of come in here and pretend everybody doesn't know how to trade. Many of you guys already know how to trade. Many of you guys already know what you're doing. You just want to sort of review it again, have another sort of understanding of how to do level analysis, right? And I think that's really what I'm here to do today is exactly that, right? This is not really for new traders, but if you are a new trader, it's fine. I would still stay here. But I'm not going to sit here and make this all for new traders. So just like introduction to myself, I've been trading for 6 years. Everything I do is level analysis, is level based. You're going to realize very quickly that the most important thing in trading is levels. You can try to go out there and create all these fancy systems and you can do all these crazy things, but the thing that matters more than anything else is levels. And the first thing I want to talk about is why, right? Why do levels matter? Well, levels matter because they are where we base our entries around, right? Our sole goal essentially is to find trend, right? Find a stock that's trending, right? And then find a level where we can optimally enter and keep our stop loss somewhere at that level or below that level. In theory, everything you do in trading, your level, it really is your stop loss, right? Now, obviously, there's things on top of that that make things more complicated, but your level is the most important part about trading. It's where you're looking for your entries. It's also where you can look for, your price action stuff. You can read price action to levels. It's how you get your edge, right? That's sort of what I've done for the last 6 years. It's really what's worked for me. You start off as a trader, kind of learning levels first. You learn levels first. Most people do. Then they think, oh, it doesn't work because they're not making money, right? And maybe they're doing something wrong. And so they learn something else. But the problem is that most people, they don't stick to it, right? They go to other like a non-level based system and they think that's going to be the holy grail and it never works, right? Every single trader I know, whether, and I'm not talking like your 5, 6, 7 figure trader, I'm talking 8 figure trader or beyond. Every single 8 figure trader beyond I know has some sort of system based upon levels. And even myself, my system is all based on levels. Now there are some approaches that don't involve levels, and that may be fine, right? There you can get arbitrage that way too, but the easiest arbitrage is going to be off of some sort of level-based system. So today's session, supply and demand, it's going to be also level-based. It's also going to be on multi-time frame analysis. We're going to go really quickly. Again, I'm not here to cater towards the new members, though I think you should stay. But let's jump right into it. So I've gone over this before, a presentation similar to this before, and we've gone over levels, but I want to take things a step further and go kind of deeper into each topic. I'm going to pretend many of you guys already know these things already. Basic idea about support resistance is essentially that a support is a area where you should see buyers, right? Or historically you've seen sort of reactions there, and a resistance is where you should see sellers. There historically were sellers there, right? So the idea about charting is you are basing historical analysis to kind of forecast important areas that you can trade in the future, right? And you're going to find that if you can get a proper level-based system, you're going to find that you typically, majority of times, see some sort of reaction off of your levels. Now, it's not the guarantee there are going to be reaction off your levels, but there should, in theory, be reaction off your levels. You can trade off of your levels and create sentiment off of your levels as well. Why do levels matter? You guys already know us. We've done this same exact presentation before. Because think of it this way, right? If you have a stock going up in price, right? A stock goes up in price, and when a stock is going up in price, you have a lot of buyers involved in that price action, right? It's a lot of buyers involved in price action as the stock is going up, because and that obviously, right? If stock price is going up, you have more buyers than sellers. If you're an institution, you can't really be getting in. You can't really be getting in when buyers are greater than sellers. Think about it, right? If you're an institution who wants to buy 10 million shares and there's only active liquidity on the sell side of like a million or 2 million shares, how can you be buying? You can't be buying, right? So what are you going to do? Well, what you're going to do is you're going to tell your quants, or you're going to tell your executors, or your traders. You're going to say, well, I want to get in Tesla and I want to get in the best price possible. What are those traders going to do? Those traders are going to look at the chart and they're gonna run an algo and they're gonna try to find the optimal entry point of the day. That optimal entry point of the day is your level, right? That's why levels matter. Levels matter not even really because of retail entries, but mostly because of institutional entries, right? Think about it. If a stock price is going up in price like this, right? If it's going up and up and up and up and up in price, obviously buyers greater than sellers, right? You need to be getting at a point where there's going to be a small area where sellers are greater than buyers when it pulls back your demand zone, and you can look for a reversion off the demand zone. That's the idea behind levels. Levels sort of help you find areas where you're going to see some sort of reversion or you're going to see reaction, right? If you have a built up resistance, right? You see a reaction if you build up a resistance for upside play, right? That's the idea is levels create levels basically are areas where you can see you usually should see institutional entries. So there are a few key metrics here, right? Metric one is going to be your support, right? And this is a price level at which an asset tends to find buying interest. You guys know this already. Resistance is going to be a price level at which an asset tends to encounter selling pressure. Pretty basic stuff. And then your supply and demand are the exact same thing, right? People will talk about levels as just like a horizontal line on their chart, and a demand is the same thing, right? But it's just a zone, right? So think of it this way. If you have a level like this, okay, and it's because historically you have price action that indicates that. Maybe you have 3+ wicks over here that indicate this is a level. So you're all happy. It's a beautiful level, right? But what if I were to tell you it looked like this? It looked a little bit funky like this, right? Where it sort of was a general vicinity. Well, can you just draw a level like that and say that's your level? Well, no, you can't, right? What you're going to do is you're going to have to sort of encapsulate that whole area as a zone and consider that now what? No longer is it support, it's just demand, right? You consider a demand zone, it's just a large area of where buyers may be. So the difference between support and resistance and supply and demand is really nothing. They're just basically zones, right? You should understand this though. Zones, we don't want zones, right? Because we don't want zones. And this is where we're getting a little bit more advanced here. Um, so this is we're kind of shifting away from the new stuff, but to new stuff. So for the new stuff, right? If you have a zone, okay, let's just say your level, right? If a level and you have a bounce area at your level, which maybe you see Apple breaking above 200. So you're like, oh, well, let's all take calls or let's all long equity at 200 in Apple. So you're all happy and dandy, right? The issue, well, there is no issue here. You look for pullback to your long area, you probably look for a position there. That's what you do. Okay, simple. Your stop loss is probably something underneath that level. Okay, pretty simple idea. Now, if you have a zone, right? Let's just say you have a zone between 220 and let's say the upper bound is 220 and the lower bound is 219, and you see a stock breaking above that whole area. Well, now where do you enter? And now where's your stop loss? See, the issue here is when you have zones, you're going to always naturally have larger stop losses because your stop loss is going to be all the way back down here at 219, right? 219 is the bottom of that demand zone. Therefore, your stop loss must be somewhere below that for your play. So with levels have the ideal risk reward because you know where you're right, you know where you're wrong. When you have zones, it creates a problem because your stop loss could be so large. Case in point was when we were trading Amazon. If you guys were trading with us Wednesday in Amazon, right? Why did I enter Amazon 3 different times on Wednesday? Because it never broke my demand. My demand was 26, I think it was 216, no, 206 to 205, right? The whole zone. So when Amazon kept ticking into my zone, I kept looking for longs, right? 206 to 205 was our demand zone. Therefore, it can create a lot of problems. So it's more difficult to trade it because you don't precisely know where you're right or wrong. And that's an issue, right? As a trader, you want to know the exact moment you're right or you're wrong. And with zones, it's more difficult to do so because you have a wider zone you're playing with. So always keep in mind, you want to have, for a clean chart, you want to have the least margin of error, which is going to be the least amount of zones and more levels. Okay, for now we're going to go back to our normal stuff. That was a fun thing. So what defines whether a level is a key or not key, right? So, well, we first have to, what is a level, right? Well, a level basically, it basically means we have historical action there, right? So it means historically we've seen some wicking or reactions off that area. Generally speaking, I look for 2 to 3 wicks off of an area on the 1 hour or the 1 day time frame to determine if it's a level, right? That's it, right? So I go 1 day, 1 hour, and I see, well, is there 2 or 3 wicks? Are there 2 or 3 wicks off my level? And if there is, then that's my level. There's something else we can do too. We can also use something called a parabolic move system, which is just a fancy way for saying look for V shapes. So if you see a stock, right, that's going up and down, up and down, up and down, and all of a sudden you see a big, crazy downside move or big, crazy upside move. Well, the low or the high of that upside move is going to be a level. The reason why is because it's known as a parabolic move. So what it would look like this. Basically, you have a stock, right? That's sort of just trending like this. And all of a sudden you see bam, right? A crazy upside move. Well, you know that that candle low of that right before the upside move is going to be a level, right? There's going to be a lot of pent up demand sitting there, a lot of pending orders sitting there for upside continuation. So even though there may not be 2 or 3 weeks here, it's just a parabolic move, a very aggressive move. Right before that aggressive move is what we consider a level. So when I'm charting daily 1 hour, I'm looking for 2 to 3 wicks. I'm also looking for very crazy V-shaped reversals. If I see that, it's a level. Don't sort of overcomplicate yourself. You can go crazy with it. You can start all fair value gaps, blah blah blah, yada yada. You can call it whatever you want, right? You can call it Krispy Kreme if you want to. It doesn't matter. Just have some sort of historical action there. That's it. 2 to 3 wicks. Maybe a V-shaped reversal, a parabolic move. That's your level, right? Simple as that. And your idea with these levels too is your levels should also be some sort of psychological based number, right? So you're gonna realize like if you have, for example, a level at like 216.7, right? 216.7, just bring it to 217, right? Round it to the nearest 50 cents, right? So 217 is your number, right? So the idea is you always want to be rounding to the nearest 50 cents, the nearest whole dollar. Now, I just said two different things there. I said 50 cents or whole dollar. Sometimes I'll do 50 cents. Sometimes I do whole dollar. If it's, for example, SPY, I'm probably going to do to the nearest dollar. If it's Amazon, AMD, Apple, which is usually less than $200 a share, I'm probably going to be going for the nearest 50 cents, right? So AMD, I could have a 116.5 bounce, whereas in SPY, I'm probably not going to have that. I'm probably just going to say 500 bounce, right? Or 550 bounce, right? The reason why is because the larger the stock, right? The larger the stock, the more likely you are to round to whole numbers. You're also going to notice on SPY's chart, SPY typically, most people who trade SPY are usually either algos or institutions. I mean, really most things are algos institutions. So it doesn't make any sense anyway. But the idea really is just round to whole numbers, right? Round to whole numbers on everything you can. And if it's cheaper than 200 bucks, go to the nearest 50 cents. Pretty simple approach. It's what I use for everything. Um, okay, and then number three is zones of price interest. So remember we said demand is basically an area of support. Well, that's all I'm talking about here. Zones of price interest is just a fancy word for saying demand, right? All of this shit is just fancy word for saying let's look for historical price action or V-shaped reversals. That's really all it is. So if we were to carry this over to a chart, which we're going to do right now, let's carry this over to a chart. So we have a few charts over here. Can you guys see my trading view? Can everybody see my trading view? Can you guys see it? Okay, cool. All right, so you guys see the trading view. Let's pull up a ticker. Let's do SPY. So we're gonna do SPY's chart. Um, and we're gonna do a reset over here. Let's not do that. Let's zoom out over here, right? And on this chart, let's remove all my drawings. And there's a few things off the get-go we can see. So notice right now what time frame I'm starting on. I'm starting on the daily time frame, right? I don't care. I'm always in the daily time frame. So what we're going to do in the daily time frame is we're going to first look for those V-shaped reversals. We're going to look for those historical wicks, and we're going to start creating levels off of that, right? And we're always starting with the daily time frame because this is the idea. This is the sort of the top-down analysis approach. We start off with a larger time frame and we move down to smaller time frames until we're all the way down to the smallest time frame we trade off of, and then we're done there, right? So when we're on SPY's chart on the daily time frame, you already see a few V-shaped reversals. Can you guys see it? You can see it, right? V-shape here, V-shape here, V-shape here, right? Those are your V-shaped reversals. Those are parabolic moves. So that's going to be already three different levels right there. Bam, bam, and bam, right? That's all we're doing. The next thing I'm going to look for is I'm going to look for where do we have our historical price action? Well, I can see I have a wick over here, I have a wick over here, it's equal, and I have some wicks over here that are equal, right? So that's one very big level there at 570 and change. So I'm probably going to have that as a level. Next thing over here, you can see many wicks over here, all in the same area. That's going to be another level. And over here, probably same idea. So what I'm going to do right now is I'm going to reset all of this, and I'm going to go back. I'm going to mark all these with horizontal lines. So let's do that. So remember, my V-shaped reversal was here at 584. So 584 is a big level. V-shaped reversal. And do you guys see this? You see how beautiful this is? 584 and my historical wicks line up perfectly. That to me is beautiful. This is beautiful, right? You can't get more beautiful than this. this is a very nice chart because you have your parabolic moves and your many wicks lining up in the same area. This is creating a very, very nice chart for us. The next thing we're going to do is we're going to chart this demand over here, or this support over here. You can see 565. But you see a problem here, right? You see 565 is clearly your level, but you also have a level here at 567. So what I'm going to do is I'm going to create a pocket of demand over here between 565 and 567, and that's going to be demand zone. And the reason why it's a demand zone is because it's one area where you have a lot of pent up support, right? You have support over here at 565, 565, but you also have it coming over here at 567. So that's going to be one zone in my chart. Remember, you don't want too many zones. You want to keep it as zone free as possible. But in this case, we have to have that. So we're going to include it. And then obviously over here, you have 600, right? You have 600 as a previous high. Could you argue this is a V-shaped reversal? Yeah, you can, right? Look at this V-shaped reversal coming in here at 600. That to me is beautiful, right? Psychological whole number 600. That's going to be a very important level for us. That's really it in the daily time frame, right? This is really all I'm doing. And again, I have some more V shapes over here. So V shape charted, V shape charted. Look at that V shape, right? These are big levels. These are all your important levels here on the S&P. And you're going to notice that if you guys know structure analysis, which maybe some of my mentees are on, you probably know this, or maybe even people who came to previous classes, you know this. Structure analysis is here, right? You can see the structure analysis. You can see level, 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 level. All your previous lows are lining up with levels as well. And that creates a really nice system for us because now we know as long as SPY is above 584, we are technically bullish, right? So not only do we use our levels as our entries, we also will use levels to gauge our sentiment. Too often people come in and they just have charts that look like this, right? A bajillion lines in their chart like this, right? And they're wondering why they can't trade. It's probably because they have too many levels on their chart, and it's because they're not deriving sentiment from the levels. Not every So for example, right, just because we have a resistance here at 600, right, 600, 601 here in SPY, it doesn't mean I'm going to short resistance, right? We're still very much clearly in an uptrend, right? And we're in an uptrend. Why? Because we're holding structure, right? We're holding that 584, 584 structure, that previous low. Every previous low that we are holding above maintains that structure. Every previous high that we're holding under maintains that downward structure. And right now we are in an upward structure. If you go back to find when was the last time SPY was in a downward structure, it was for a blip between March and April, right? You can see it was holding those lower highs, those lower highs, lower highs, lower highs, and finally it broke above over here in May and been in a bull structure ever since. You could also argue it was also here as well. You saw a little bit of a downward structure between July and August, right? You can see a lower high, a lower high, a lower high, a lower high, and a lower high, right? But obviously now we're clearly in a bull trend, and we're still in bull trend as long as we're holding above now 584, right? Now, if we pull back and create another V-shaped reversal over here, okay, somewhere at 590, for example, that's going to be our new bullish sentiment level, and we're going to use that as our gauge for calls. If we're uptrending daily, we're looking more so for calls on SPY, right? So the idea here is we're charting our levels based upon our V-shaped reversals and our historical wicks, 2 to 3 wicks. And we're also going to take it a step further by saying, well, you know what? I'm bullish because of this. I'm bearish because of Y, right? And if you have that mindset, then you're not going to be sort of guessing, right? You're going to be saying, well, I know SPY is bullish right now because SPY is above 584. And as long as SPY is above 584, I'm bullish. Why? Because it's the most recent structure. It's that most recent V shape, and henceforth, that's why we're looking for calls, right? So this is just a general rule of thumb. Now, granted, you could still short the resistances. You could still look for shorts at resistance for downside moves, but you're going to be against the grain. You're against the grain if you are against the daily uptrend, right? And that's the general rule of thumb. Now you can take it a step further. So this is just the daily time frame. Let's now go 1 hour time frame and dig deeper into this. So on the 1 hour time frame, you're going to find a new set of levels which can create possible areas of entries. SPY has been clearly in an uptrend, right? I mean, how much more beautiful can you get? But you can see here that our level on the daily time frame was right. But when I'm looking at it now, I can see it's not just 584. It's actually kind of 582, right? So we have a big zone we have to chart out here. It's 584 to 582. as a potential bounce area here in SPY. So my main bounce area in SPY is at 584, 582 because it's a big demand zone. You can see where a lot of pocket of support over there. Well, what else do we have? Well, we clearly have a level here at 600, right? And 600 is a very big area. I'm not going to chart it as a zone, even though I could potentially do that, but 600 is just a big level for me, so I'm going to keep it there. What else do I have over here? I have 590, right? At 590.5. You can see a high and a downward move and a reclaim and a big upside move and kind of reactions and reactions and reactions here at 590. So 590 is going to be a big level for me. What else do I have? I also have to chart out the all-time high, right? And we're right at the all-time high right now. So 603 is going to be charted as an all-time high. Now I'm going to go to the 15-minute time frame and we're going to chart the 15-minute time frame to see what's going on here. 15-minute time frame. Anything else I'm missing here in the 15-minute time frame? You could argue maybe there's a level at 595, right? That would be a level I would have to add into my chart. 595 as a key level of support. Now, technically speaking, SPY is bullish as long as it's above 584, but that's only on the daily time frame. SPY in the 15-minute and hourly time frame is only bullish if we're above 595. So this could be a sentiment gauge for me on a smaller time frame is going to be a 595 potential hold. If this is holding for me, we're looking for calls. But if we fail this 595, then we can probably go back all the way down to 584 as our daily test of demand, right? So I'm going to use this as a gauge. I even would even argue, like, look at this, look how beautiful the 600 level is. This is a really, really critical level for SPY right now, right? It's a very critical level. If we fail back under 600, even though we're still technically bullish, I would have a hard time longing because you're going to see if we do fail under 600, we should very quickly go to 595 and possibly even 590 and beyond, right? So you have some really big levels on SPY going into this week. And all we're doing is we're just charting on the daily, the 1 hour and the 15-minute. That's all we're doing. We do the same thing every single time with the same exact approach with no differences, right? And notice my levels are 599.94, but I know it's really 600. I know this is really 595. I know this is really 590. I know this is really 584, right? So even if you have your numbers as exact, precise numbers, it's fine, right? Just understand that you're going to be rounding down when you are trading it or rounding up when you are trading it. This is levels, and this is all we're doing. Going back to our presentation now, right? Let's go back to the presentation. Um, what defines whether a level is key or not key? This is really important. I want to answer this question. So the larger the time frame you're on, the more important that level is. It's very simple. If you notice this, right? So you notice what I said here. I said, well, you know what? If SPY gets under 595, we're going to go back to 584. But what's stronger? What's the more important level? Is it 595 that's the important level, or is it really 584 that's the important level? It's always going to be the daily time frame level. It's more important. It's going to be the 584. Why? Because 584 is that daily time frame level. But anytime you have a daily time frame level, it's going to be more important than any of your smaller micro time frame levels. Go in order, right? Daily is going daily and then 4 hour and then 1 hour and then 15-minute. And the smaller the time frame you get, the less important it is. Now maybe you could disagree with that. That's just my opinion, what I do. It's fine. Everything else you should probably agree with for the most part because it's pretty universal information. But this is where it gets a little bit more personalized. Is for me, I focus on the larger time frame levels. Larger time frame levels are more important to me. Okay. The second thing is someone else said I have a hard time going long into all-time highs. Absolutely. So do I, right? So ask yourself right now, if you have your levels charted here on SPY, how do you trade this? Like, what do you do? Well, you have to understand the trend is still bullish. So sure, having a hard time going long is difficult, right? When we're all-time highs. But you can mark out areas where you could go long, right? In theory, you could probably go long off 600, right? That's probably a long spot. You could probably go long off 595. You could also go long off of 590, right? There's all different long spots on SPY. So the idea is that even when you are pushing new all-time highs, you're going to revert back to your level system and you're going to look for entries at these levels. And it doesn't mean just enter at every level. It means look for your entries at every level, right? Look for your confirmation of whatever your execution approach is at your levels and see if something yields. And if it yields, you take the trade. The idea basically is you're looking to see where your optimal entries are, and that's where the levels are. Levels are likely your optimal entries. So that's what you're going to be doing is essentially looking for pullbacks at 600, pullbacks at 595, pullbacks at 590. Now you could technically short, right? You could do it. You could short the highs, right? But you have to understand there may be support at 590 at 600, right? There may be support here at 595. So the idea is that no matter what you're doing, you're always respecting some sort of level-based system, no matter what you're doing, whether you're long or whether you're short. So what defines whether a level is key or not, it's based upon the time frame. If it's daily, it's more important. If it's 4 hour, it's less important. If it's 1 hour, it's even less important. If it's 15 minutes, it's even more less important, right? So that's the idea. So, I can go over more stuff here. Obviously, you're going to see this is a good example of multiple wicks, or you can see multiple wicks at the same level. This is when SPY was trading at 444, which is pretty crazy. Uh, I mean, that's really crazy. That was just in September of last year, I believe. So 444 SPY was trading at. Obviously, right now we're trading at 600s, right? Pretty crazy. So 444 SPY was trading at, and that was obviously a big level. You can see lots of sort of um, wicks here. And you also can see a parabolic move, right? A little V-shaped reversal. That's going to be a level. Another V-shaped reversal came in over here at 453. You can also see you have many levels lining up the same area too, many wicks and reactions lining up the same area. So general rule of thumb is we're looking for either levels or V-shaped reversals. This is an example of someone else's chart. This is not my chart. I think this is from, I don't know who this is from. It might be from S&P Capital or something like that. But you can see here resistance level are represented as a zone, right? You see what they're doing, right? They're putting an implied resistance here, then they're putting the absolute high, and this is going to be their zone, right? So that's the implied. This they're calling it a false method. I don't know what they're talking about, but this is just going to be a zone, right? So this is just a zone of resistance, and this is a zone of resistance, and this is a zone of demand below, right? That's the idea here. Is you're just charting zones if you have to, right? In this case, I probably would just chart it as a level right there, and they're calling it a false method, but hey, who cares? So let's move on now. Let's move on to the last thing here, which is going to be incorporating your levels with also trend analysis. You could also see that this was an Amazon chart. This is a trade that we had taken back last year, and it was a really good trade because you can see here we had a level built here at 137, 137, 137. We broke above it. We came back. We tested that 137 level. We went long off 137. We kind of moved all the way to 140 plus. It was a really good trade, and it was basically sort of mixing in our level-based system with also a trend line, right? You can add trend lines to make your system even more powerful and increase your win rate and have a much more fun time. Determining the strength of a level. So we kind of talked about this, but time frame, right? The most important thing is time frame. The larger the time frame, the stronger the level, right? It's a pretty basic concept. Untested levels equal stronger. So notice here on, where is it? Oh, here, right? Notice here on Amazon, right? Notice it was technically the best time to trade Amazon was over here, right? Why? Because when it first broke it the first time, it was untested, right? Until it tapped it the first time and you got the big upside move, right? So over here, well, it is a good trade. The better trade actually was over here because this was a stronger level at that moment. Why is it a stronger level? Because it's an untested level, right? Any level that's been broken, it's been untested first. When it tests it for the first time, it's usually a better experience. Because why? Because all those pent up buyers that are sitting there are fresh, right? They're fresh orders sitting there. When you tap it a second and a third and a fourth time, you have a higher chance of breaking that fresh level, right? Because remember, you have to think about it from like a buyer perspective. If you keep seeing if you're a buyer, right, and you keep seeing your level keeps getting tested, you kind of are like, maybe there's a potential of me getting stopped out here, right? The more times level gets tested, the more likely it is to break that level and reverse downward, right? So that's the idea. Untested levels, generally speaking, are the better levels because they have stronger reactions. The more testable level inherently becomes weaker. The larger the impulse off the key level equals stronger level, right? So remember that parabolic move system? That's kind of the idea here too, is that anytime you have like a big reaction off a big level, of course, it's a big level, right? And then also your cycle levels. So right now, SPY going into Monday session, what do you think we're gonna be doing on Monday, guys? 600 on SPY. That's our level. 600 on SPY is our level. If we're above 600, we are in bull freight train mode. If we're below 600, maybe we fail back down to 595, right? Maybe that's a short. Maybe if you want to short on Monday session, you probably would want to see us back under 600. That's what you're going to want to look for, is a move back under 600 for a shorts. So, and the reason why 600 is so important is because not only is it a key level, but it's also a psychological level. Psychological levels are really important. They're really impactful, and they matter to me more than anything else. So that basically is everything there is to know about levels and multi-time frame analysis. I did this class very quickly because I care about you guys' time. I also know that generally speaking, This is actually, I think, our second or third time we've done level analysis. But you can see this time we've gone through things a little bit differently, and we went over things that we didn't go over last time, which I think is always good to do. What did you guys think? Was this helpful? What did you guys think? Can we go through some tickers? Yeah, I'll go through some tickers. Yeah, we'll go through a few tickers. I'm thinking we'll do a speed round of some tickers. So we'll speed round it. If you guys have some tickers, type in the chat. We'll speed round it. That I think will be good. So type it in the chat. We'll speed round some stuff. We'll do Apple, INTC, NVIDIA, DraftKings. Let's do everything. So let's do Apple first. Apple, I'm gonna go off, guys. I'm gonna go off the levels I had previously. I'm not gonna try everything from scratch, right? Just because it would be a lot of time to do that. But here in Apple, obviously, new all-time high being pushed out, right? This is a new all-time high being pushed out. If it breaks this 237, we're going to be in price discovery mode. We're going to be in that crazy uptrending move, right? I remember we said the more time you test the level, the more likely it is to break it. We're breaking this level now. If we're above 237, we turn to support these highs, and these highs, we're going to rip higher and make a new high here on Apple. Pretty simple, right? 237 breakout. If it keeps breaking out, we're going to go. We can look for longs there, or we can look at that 230 bounce, which is a nice area for longs as well. So watch this bounce zone and watch the break and hold above 237. That is Apple. Let's go to INTC. I was sweating on Wednesday because I thought I was going to get stopped on my shares. I have a lot of shares in INTC. I think we entered at like 20, I think a 19 or 20 share. We're at 24 now. But my stop loss is really that low, right? That low is my stop loss now. So as long as INDC is holding 23, we're looking for longs back into the bull flag highs, which is probably 27 and beyond, right? So as long as INTC is holding, we're holding. Okay. Let's move on. Let's do DKNG, DraftKings. DraftKings interesting, right? Look at this. Wow. So you can see a lot of reactions coming here at 44.50, right? Very nice level, right? Very, very nice level. Look at that. I mean, daily level as well. So if it breaks 44.50, this is going to go higher back in at 50, right? It's the next big level of support or resistance rather, 50. Let's do NVIDIA, NVDA. NVIDIA. NVIDIA is at a huge level, right? And you really got to take a second and just look how important this is. This is 140 here in NVIDIA. It's a massive trend line. It's an hourly level. It's a daily level. If it can reclaim 140, it's going to rip to 150. If it can't reclaim 140, bad news. It's going to go back down to 127 probably, right? That's what's going to happen. This is going to make a 10. This is going to make a $10 move probably in the next coming days. I think if it reclaims 140, you have big upside potential back to 150. If it fails off the 140, you know where it's going to go. You know it's going to break 132. You know it's going to go to 127.50, right? So that's your idea here is it must break above 140. If it breaks 140, you're going to have a really nice squeeze upside reversal. If it fails this level, you know where it's going, right? And right now, look at it. You have to look at this for a second, right? Look how important this is in the 4 hour time frame. In the 4 hour time frame, you have a nice little ascending wedge, whatever you want to call it. But you just the trend line to me. We lost that 140 level where we closed right into it on Friday session. If we can reclaim 140, that's going to be huge for NVIDIA, right? It's going to be a really big day. Same thing with AMD, right? AMD's been really weak as well. It needs to reclaim that 140 level. If it does, that's where you're going to have the upside come in. Anyway, I think it's a good refresher. I think this is a good session. We had a lot of you guys join in today, which is awesome. I know I didn't answer that many questions, but what I'll do is if you guys have questions, type it in the questions tab in the Discord and I'll help you guys out because we're gonna be here all night if we sit here. So for me, I'm gonna call it. I'm gonna go